Hi, I'm Melissa Withers, managing partner and co-founder of RevUp Capital. If you're watching this video, you may already know that RevUp uses a non-equity model to invest into fast-growing companies with non-dilutive capital and world-class support. But what kind of companies do we select? What do we look for in a new investment? That's what I'm going to cover in the next few minutes. My partners and I created RevUp after working for many years as equity investors. We wanted to break free from the exit or bust constraints of the equity-only model. So rather than take equity in a company, we use what's called a revenue contract to generate returns. In short, companies return a small percentage of revenue over time until reaching a predetermined cap. This usually takes between 4 to 5 years. We've used this model to invest into more than 50 companies since 2016. And while not every investment has been a smash hit, across the entirety of my career, RevUp founders are hands down some of the finest and most talented entrepreneurs that I've ever worked with. So let's start at the top. What do we look for in a new investment? We invest into both B2B and B2C companies with revenue traction, a solid growth rate, and a strong team. Across the fund's history, we are split about 70% B2B and 30% B2C. But one thing that all of our companies have in common is stage. We invest into companies that are just beginning to ascend the $1 to $10 million growth curve. If you've conquered this curve, you know just how hard it is. If you haven't but want to, having the right strategic investors along for the ride is crucial to success. That's because going up this curve is super challenging. Many of the approaches and behaviors that get a company to its first $1 million in revenue don't help them get to 10. In some cases, these approaches and behaviors may even be a serious barrier to getting up the curve at all. Our companies understand this, and they are looking for investors who will increase the chances that they'll succeed. So I guess you can say we're gluttons for punishment because we invest at the bottom of that curve. And we've optimized our investment approach for this leg of the company journey and to help more of our companies get to the top faster. For specific selection criteria, let's break it down in two parts. First, baseline economic criteria, and second, company profile and culture. For the baseline, we are typically investing into companies that are in the market, actively selling, and ready to grow to 10 to 15 million in the next few years. These are companies that make and sell products that their customers want and need. Our companies typically come into our portfolio with annual revenue between 500K and 2 to 3 million, but we also care a lot about growth rate. Our companies may need more fuel on the fire to go faster, but they're not stalled out or stuck on the tracks. We only invest into companies that can comfortably support a revenue-based investment. So if you're really early or your business runs on very low margins, a revenue-based investment just might not be the fit for you. In this spirit, we invest into companies that have solid underlying unit economics and or a path to profitability. Burning isn't always bad, and there's nothing wrong with investing into growth if you have the right resources in place. But after investing in 100 plus companies, I assure you that getting a company to cash flow break even is a good place to be, even if a company chooses not to stay there for very long. It's all about optionality. More optionality makes a company harder to kill and more resilient when faced with the unexpected. Beyond these baseline criteria, we look for companies that have operational and cultural qualities that track with our mission and values. So through this lens, we select for companies with a strong leadership team and proven execution ability. Our founders may dream big, but they also know how to operate. We seek out teams that are ready, able, and willing to build a more scalable marketing and sales engine. For many, this might mean moving away from purely led founder sales. This might mean building on what you learned from your initial go-to-market effort in order to expand, and it almost always means a readiness to bring new capabilities into the mix. And since we're talking about team, since 2018, more than 70% of RevUp investments have been into companies led by a woman or person of color. And many of those that weren't were into companies where the founders were building their businesses outside networks of privilege. They weren't coming with fancy pedigree or building their company in top tier markets or self-funding with lots of personal wealth. But that has not, did not, and will not stop them from building really big, successful companies. These are our people, and that won't change anytime soon. But perhaps more importantly, we select for companies where we know we add unique and strategic value. While we were one of the first to bring revenue-based funding to earlier stage companies, we remain one of the very few that use a high-touch portfolio-based model. This is a stark contrast to the high-volume transactional models of many others in the space. Our model also combines our cash investment with intensive hands-on support to help companies build a stronger, more scalable marketing and sales engine. Building this engine quickly and efficiently is critical as companies move from early traction to sustainable growth. This is a time when missed opportunities and market-facing errors can make the difference between success and failure. So, to give our companies the best shot at success, we built an internal growth platform that we offer to all of our investees. This platform includes tools, processes, and people to help our companies scale faster. We never want to be the sole reason our companies succeed, but we do want to be a force multiplier. We want to amplify and simplify, expand and support in ways that help our companies go faster. Getting up the $1 to $10 million curve is a battle, and we know that it takes a lot more than money to win. So if it's not obvious that our growth platform or our management team adds important and strategic value to a company, then we probably won't invest. And that's it. Well, that's about all you can fit into a 5-minute video. You can always find more info at revupfund.com. Thanks for watching, and I hope that I'll see you soon.